We at Merrill Lynch have had a 50-year partnership with Execs, a very fruitful partnership. And as you know, we are bullish on America. Always have, always will be. And as you recall, last year, our guest speaker, Richard Golod, was also bullish on America. And he was bullish on South Florida. Now, the two main reasons he's here today are, one, to get out of the north, and two, to make good on his predictions of last year. So, a great big Fort Lauderdale welcome to our speaker, Richard Golod.
Thank you very much. So, Tony, where did you sit in the movie theater? Were you in the front? Okay, yeah, right? Ed, thank you for including me in your prayers today. I need all the help I can get. Economic Forum, I'm not an economist, so that's a strike already. I'm a top-down macro strategist for Investco. I'm their global strategist. I'm 30,000 feet in the air trying to figure out where I believe investors have the highest probability of making the most money with the least amount of risk, and Merrill Lynch is one of our important and key partners. I spend 97% of my time with advisors, so I apologize if I use terms and phrases that are unfamiliar to you. But I obviously have to know something about the economy to come to some kind of a forecast on the markets. Last year at this time, my forecast was the S&P would close at 2060. It closed at 2058, so I was a couple points off. I know, loser. God. Can't get any better than that with the information flow. See, if I have an advantage over anybody, I have 150 analysts and about 100 junior analysts crunching numbers. I'd like to think there aren't too many things that we haven't figured out and quantified. And the message last year was a couple things. One, money moves markets. And if you just looked at the countries that had the most aggressive monetary policy, there was a good chance they had the best stock market performance, and that's exactly what happened. Japan their market has doubled. It's up over 100% in the last 2.5 years, and they had the most aggressive monetary policy in that the Bank of Japan, their central bank, was injecting more money as a percentage of their GDP, in fact, 5 times more than the United States. We were second, our stock market was second, and Europe was third. So if we wanted to figure out where to invest our money this year, we might say, well, who's got the most aggressive monetary policy going forward? It would still be Japan number 1, Europe would be number 2, and the U.S. would be number 3 as far as major G7 or G21 countries. And on the economic side, we talked about how the economy was much stronger than the data would suggest because the sequester was a $350 billion negative against GDP. It was actually subtracting about 1.5% of growth. And this year, it's about a $50 billion negative. In other words, we're finding that the government's starting to contribute positively to GDP, not negatively. So if you want to figure out where the economy is going, let's just recall there's 4 drivers to the U.S. economy. There's government spending, corporate spending, consumer spending, and overseas demand. So the government's now starting to spend a little bit more. When I say the government, state and local governments are responsible for 85% of government spending. The federal government only about 15%. And what I'm seeing, and maybe you're seeing that here in Florida, state and local governments are no longer in austerity mode. They're starting to hire people again. They're starting to spend on infrastructure. I don't know what the road system's like down here, but up north, there's a lot of construction going on. And so that's a positive. What I'm hearing now is that corporate spending, which we call CapEx, boy, that's going to undo the economy because the decline in oil and gas CapEx is an important part of total CapEx, so we think, or so it was said, and that's going to offset and really drive us into recession. because history has been quite clear that when energy prices fall, it tends to precede a recession, but that's when the U.S. used to be the price setter of energy. We're not the price setter of energy. Who's the price setter of energy? It's China. China's going to be slowing for the next 5 to 10 years. That's not an opinion, it's a fact. And I'll get into why in a second. Yes, demand-driven declines in energy prices do lead to recessions, but supply-driven declines lead to above-average economic growth. So when I was fielding questions from our internal people, CapEx is going to lower GDP, I said, well, how big do you think oil and gas CapEx is? Total CapEx, or corporate spending, drives 15% of GDP, and oil and gas drives 0.8 of that 15. So oil and gas capital expenditures is $179 billion spend. It drives about 1.2% of GDP. Is there an offset to that? We know that the biggest driver of GDP is the consumer, who drives 72% of our economy. So I'll just give you a simple number, and let's put a face to that number. Every penny decline at the gas pump puts $1.5 billion in consumers' pockets in a year's time. 1 penny equals $1.5 billion. And the decline in gas so far from a year ago will add almost $200 billion in additional disposable income. That will add almost 1% to GDP. And what I mean by that, let's put, again, a face to that number. And I'm going to pick on a particular industry only because I've seen it in Annapolis. When I've had construction people work on my house, they spend every penny they make. They live paycheck to paycheck, don't they? So let's take that construction person, and now they've got an extra $40 in their pocket last October. I'll give you 3 guesses what they're going to spend it on. You'll get 2 of them right. Would beer be one of them? I'm just, not that there's anything wrong with beer, but that's certain, and maybe more beer. And now they've got $200. Now we're talking renovating the man cave, right? It's the 83-inch TV, because the 60 is not big enough. But let's think it through. His birthday's Saturday night. He loves steak. Is he going to Capitol Grill, or is he going to Outback? Is he taking his family to Saks Fifth Avenue, or is he shopping at Walmart and Penny's and Target? Hasn't been on a vacation in 5 years. Where's he going? Right down Disney World, right? Disneyland in Orlando. Cruises? Absolutely. Think. We're talking about middle to lower class that hasn't had a wage increase in a decade, pent up demand, and now they've got an extra couple $100. How about car sales? What do we know about car and truck sales when gas prices fall? Bigger engines, bigger trucks. You know any companies that make big trucks here in the U.S. starts with an F, ends in a D? Yeah. So if we have car dealers here, they'll tell you, with financing being what it is, I'm sure business is picked up because the average car on the road's over 9 years. So there's certainly pent-up demand in durable goods, in cars, in travel, in recreation, gambling. You think any of them are going to start going to the reservations? And absolutely. In fact, that's where I see some of the great investment opportunities. And what else are we seeing? So if the consumer drives 72% of economic growth, how's the consumer doing? There's only 3 ways to spend money. Spend what you make, spend what you have in the bank, borrow. Borrowing's at lower rates, right? So now we have just a decline in interest rates. About 70% of mortgage holders now qualify for refi, which is going to do what? Put more money in their pockets. I follow the job growth. Right now, the job growth last year was the best we've seen since the 1990s, in 17 years. Yes, you heard that fourth quarter GDP was 2.6, very disappointing. What they didn't tell you is exports, it was 3.6. Private sector GDP was over 4. This economy is a lot stronger than people realize. Everybody focuses on the hourly worker. The average hourly worker pays up about 2.2. I don't know. Does everyone in here work on a per hour rate? Because I don't. I'm not paid per hour. Wages and salaries last year were up 4.4 in a country that had basically zero inflation. Again, more disposable income. Consumer confidence, 70%, spending is 70% correlated consumer confidence. Consumer confidence is at the highest level in 9 years. Consumer sentiment, the highest in 11 years. Disposable income, the best we've seen since '06. We have more people working, making more money, working longer hours. And now with energy prices down, disposable, more money to spend. The high-end level areas, the retailers and such, they've been doing great throughout, but now that middle restaurant sales, the most disposable of disposable income. Cracker Barrel, the I don't know, you've probably seen them on the roadways. I haven't eaten at one, but their stock is up like a rocket because more people are going out to eat in that middle to lower income level area. So I don't see that changing anytime soon because we're producing more energy than global demand. And I'm here to suggest that some of the declines in energy is political. And I say that because of a conversation I had in November. I was contacted by a consultant for the Secretary of Defense, and I was asked to go to the Pentagon and meet with the director and deputy director and their group for the Office of Net Assessment. Now, this office, if you haven't heard of it, Congress has now funded that to perpetuity, and they have passed a law last year that you cannot eliminate this office. And it's their job to figure out where the military needs to be 3, 5, 7, 9 years. And it was supposed to be a 1-hour interview. And the director, who just retired, a legend, he was written up in The Economist, he was written up in the Washington Post last week, wanted my views on US, Japan, Asia, Latin America, and Europe. But we went a second hour because the second hour was, let's get a little deeper on your views on China and Russia. And the last name Golod, G-O-L-O-D, if you're not familiar with Russian, is the Russian verb for hunger, and my grandparents are from the Ukraine. I'm a little interested in what's going on over there. I'm following a little bit. And I said to him, on Russia, that we have a tremendous opportunity if our administration get on board, because I saw something that reminded me of what happened in the 80s during the Reagan years. Some of you remember the Strategic Defense Initiative known as Star Wars, and there was a lot of protest and backlash on that, and until you realize what it was really all about. It was about getting Russia involved in an arms race. We had a deeper pocketbook. We knew we would bankrupt their banks over time, and it really led to the fall of the Soviet Union. I said, we have a chance to do this again. I mean, think about what Putin did. He just completed the Olympics. I don't know about what you thought. I thought they did a great job. And within a week, he's sending troops into the Ukraine and taking over Crimea. What? Because he knew his clock was running. He had less than 2 years. Within 24 months, we'll be in a position to export natural gas. And what we'll do is use that as a political tool to undermine Russia in delivering natural gas to the Ukraine, which is about 88% of their supply comes from Russia, and Germany gets about 36% of their natural gas from Russia. So all of a sudden, we can go in there and offer below-market contracts to get people to do what we want to do. You're going to see the U.S. gain global prominence again because we're going to use energy as an arm-twisting, and maybe that's a little harsh, but we're going to get people to do what they want them to do, what we want them to do at the UN and in NATO, and because this is an economic tool that's very much in need, and so he's got 24 months or less to get as much land as he can. It's a land grab, and he misplaced, I think, a political pawn, if you will. But in '08, he went into Georgia, rattled the sabers, and then he left and took a little land with him. And I see that's what he's doing here, or trying. And when he wants the land that are dominated mostly by retired Russian military. Crimea is like taking over San Diego. It's all Russian retired military that have been cared for by the state since they were born, in my opinion. So his time was limited, and now he's getting the political backlash because we have driven. What did we do? We went to Saudi Arabia and said, we need your help. Why don't you just open up the spigots? Full bore. It'll help you take care of your nemesis, Iran. It will remove the marginal producer so you can better control oil prices in the future. So in other words, right now we're producing over 9.2 million barrels a day. We haven't had that kind of production since 1983. Energy stockpiles are the highest since 1982, and we don't have records that go back farther than that. So excess inventory would suggest downward pressure on prices, and we're still producing the most we've produced in years. And so is Saudi Arabia, because for Russia, 85% of their tax receipts are from oil and gas. In other words, we're crushing them economically. Crushing them. Their currency is down 52%. What does that mean? That means whatever you were paying yesterday is twice as expensive today. You just reduced their net worth. You cut it in half. Inflation is over 11.4. Wage growth has fallen over 7% since the beginning of the year. Auto sales are off 24% in 1 year. 24%. If that's not a depression, I don't know what is. And so all of a sudden, what's happened in the last couple of weeks? It's about pain. When will energy prices bottom? When Putin pulls out of the Ukraine. This is an economic stranglehold. Now, I worry that desperate people do desperate things. So there's some geopolitical risk in the world. But the fact of the matter is, we are punishing the world's bad boys. That's Russia, Iran, Venezuela. And they're just losing any political capital that they might have had because they're crushing their economies. You're likely to see energy stay in this $50, $60 range for quite some time, in my opinion, simply because we're producing more, as I said, than global demand. And what normally would happen in oil is when it drops below the break-even point, you would just cap the well and cut off supply, so it tends to be mean reverting. But now countries are tying their debt to energy. They're actually producing more because of the drop in price to come up with the same revenues. So that might persist throughout the year. Now, is that negative for the U.S. when every penny decline at the gas pump puts $1.5 billion in consumers' pockets? How's that a negative? Oh, it's going to cost oil and gas jobs. Okay, how many jobs have been created in the oil and gas industry since 2009? 819,000. Okay. How many outside oil and gas? 9.5 million. It's not big enough. Yes, they're better paying jobs, twice the national average, yes. And you might say there's a multiplier effect because the demand in energy might be creating a restaurant and other jobs around factor of 2, factor of 3, but it's not going to offset 9.5 million jobs. So not only are we seeing more jobs, but it's the age group that I'm seeing the jobs. For the first time, that 25 to 34 demographic. Their confidence is rising, their jobs are improving, and their wages are growing. These are the people who do what? They form families and buy homes. Will Broward County benefit from having more demand for housing? Mortgage applications up 24% in the fourth quarter. We're seeing more building. We're seeing banks, or I'm seeing banks, because what's really hurt real estate isn't so much the demand as it is the ability to get financing, isn't it? Lending standards are still too tight, but what's been happening over the last 3 months? They're starting to relax those lending policies. I think you're going to find banks getting back in the business of lending. So as an investment strategist, do I like regional banks? Yes, I do. Because I see more new construction, more demand for housing. We're already seeing it on the apartment area. Rents are rising. Maybe it's a different type of home. One, to take care of those that are over 55 or 65. At least in my group of friends, the 10, 14,000 square foot house just doesn't have the appeal. We're looking at things that are smaller, bigger rooms, smaller rooms, but a little bit more manageable. So I think you're going to find the recreation, the travel, the demand for real estate, the demand for autos, health care. I was in Pasco, Washington a week ago. I know. I don't know why I got roped into speaking to a different group like this, not as prestigious as this, not as many of you there, but Pasco's in wine country. They also have a laboratory there that makes a discovery a day and files a patent a week. And the director there gave me something the size of a thimble that was a 100 magnification microscope that goes over your smartphone. So that little lens on your camera, it slips right over the lens, and so now I can look at a screen, and whatever I'm looking at is magnified 100-fold. And it costs 37 cents to make. It really was designed for the third world. I'm not sure I need to look at anything that's magnified 100-fold, but you could see in the medical field that would be a big benefit. And these are the things that biotech, expensive stocks, yes, but their earnings growth, the things that we're discovering, and you're picking up those kinds of businesses here in this region. So I think you're going to find things aren't going to get worse, they're going to get better. And they're going to get better because the consumer's going to have more money, and this is a great destination point, especially South Beach for those of you down there, obviously. I know prime Italian, that Kobe beef meatball, yeah, okay. I digress, but that's my other love is food and cooking. So yes, I think you're going to find the economy is going to do great. I think what's going to surprise a lot of people is a lot of investors believe that great economy, great market, and that doesn't always follow. In fact, I've been saying for 3 or 4 years and reminding advisors, economic growth does not determine stock market performance. It's the biggest mistake people make. The correlation between the economy and the stock market is minus 0.1. It's not correlated at all. Some people think that earnings impact the market, and they'd also be wrong. Corporate earnings and the stock market performance is correlated at 0.19. It's really about the flow of money. Oh, earnings can matter at certain times, but it's not the only key driver. So the economy is going to do great, but because of the strong dollar, which I believe is in the early stages of a bull market, so those of you doing business overseas, that's going to be a headwind. The dollar is still trading 25% below, or 25% below where it was trading before the tech wreck, and 50% below where it was trading in 1986 after the Plaza Accord. And the reason the dollar is going to continue to strengthen, it's not so much the dollar is going to strengthen as most central banks outside the U.S. are trying to weaken their currencies to give themselves a pricing advantage in a world where there's relatively no growth other than the United States. It's the U.S. and then everybody else. 90% of our economy is domestic demand driven. So last fall when we were hearing about, the slowdown in Europe is really going to affect our growth. Really? Because it never has before. Europe has never taken the U.S. into recession. There's so much misinformation out there that's in the news media. I hope you're not giving it too much weight in making investment decisions, because right now there seems to be a negative bias to about everything that's reported, in my opinion. But when I look at the dollar strengthening, yeah, it's not a problem if it's a slow, measured pace, because companies can hedge, they can transfer their manufacturing, but speed and magnitude can disrupt that and negatively affect earnings. So that concerns me that unit wages, the margins are starting to compress a little bit or expand a little bit because unit labor costs are rising. So all of a sudden margins come down a little bit, earnings aren't as attractive as they used to be. And that's usually not a problem unless the market's at full value. And right now the market looks to be fully priced for the most part. In fact, since October, the stock market, the S&P 500, has been tracking the S&P 500 volatility index, which has been tracking energy volatility. They're 90% correlated. So you could pretty much tell immediately what the market was going to do just by watching the volatility in the energy sector. So that's been coming down a little bit, and that's why the market's close to an all-time high. That's why we've been rallying. It's just that all of a sudden things look less risky out there. And that's another thing that's important to remember from an investment standpoint. It's not about waiting for something to be great. It's looking at something, if you're concerned about anything, ask yourself, does it look like it's getting worse or less bad? Because things that look less bad, the prices go higher. Professional investors buy things when it looks less bad, if that makes any sense. So when I look at Europe, all of you know more about what's going on in Europe than you realize. Europe is a replay. It's the same movie you and I watched in the last 4 or 5 years here. It just has German subtitles. Draghi is following the same script. What did our central bank try to do, our Federal Reserve? Fix the banks, fix real estate, fix the consumer. Where is Europe on that? They're still fixing their banks, aren't they? And what was missing is, if we talked about quantitative easing, would you say that quantitative easing saved our economy? That's debatable. How about our stock market? Oh, fourth best bull market in history. Did quantitative easing fix Japan's economy? Questionable. But I do have a stock market up 100% in 2.5 years in local currency. So when you look at quantitative easing and ask, is this going to save Europe's economy? No. Quantitative easing is not designed to fix the balance sheet. It's designed to fix the income statement. What I'm saying is, when you have more debt than liabilities, QE doesn't, all it does is buy you time. That's all it does. But it didn't pay you to fight the Fed. It didn't pay you to fight the Bank of Japan. And I submit it's not going to pay you to fight the European Central Bank. Their market's likely to go higher. In fact, the stock market in Germany is up 11% year to date. The region's up over 8%. And that was forecasted in my January outlook. I went to an overweight in Europe for the first time in like 3 years. It was pretty easy to see that liquidity would move the market higher. Don't be surprised if you see 100 euros to the dollar within a year and a half or less. So what's that going to do, besides you and I going to Italy and France? But you're right, tourism's going to pick up in a big way over there. First, the Germans, well, they're exporters, so they're going to do well. And then Fritz is going to look at his wife and say, instead of going to Orlando for August vacation at Disney World or Disneyland, let's go to Greece or Portugal or Spain. Countries that are made up of a lot of their economy is made up of tourism. So the exporters will do great first, and who gets the advantage? Large multinational companies that gain a pricing advantage. So when I talk to advisors at Merrill Lynch and other firms, what should you buy? Well, what did people buy here when the economic future was uncertain? Because it is uncertain in Europe. Well, you buy big companies with predictable earnings in the non-cyclical sectors that perform whether the economy rises or falls, that pay dividends or increase dividends every year. Same companies that did well here for the last 5 years. Europe is where the U.S. was in 2011, in my opinion. We were worried about a double-dip recession. We were worried about deflation. And the central bank, our Fed, stepped in and injected liquidity, and that's what Mario Draghi is doing in Europe. And Japan, I'll make you an expert in Japan's stock market because Japan only has one moving part, only one. Their currency, the yen dollar goes down, stock market goes up. Your currency goes up, stock market goes down. That's it. It's not about population. It's not about earnings. It's not about demographics. It's not about anything other than yen goes down, market goes up. Correlation 91%. So when you wake up tomorrow, Sue, and you got the news and you're still waking up and you hear the yen's down, you can roll over to your significant other and go, the Nikkei will be up today, and you'll be right. He'll go, how do you know that? Take over our portfolio. Start making our investment decisions. You'll be right. One moving part, one risk. They want a little bit of inflation, not a lot. Right now they have a little. But what might surprise you is what's going on in China. If I asked you what percentage of GDP is driven by exports in China, would you say 2%? That's what it is. 50% of China's economy is driven by investment growth. There hasn't been a country on the planet in history where GDP was driven 50% by investment growth. It's actually 47 right now. It's unsustainable, and they know it. And so when you've already heard they want to move from investment growth to consumer growth. What they didn't tell you is investment growth in China creates 12 jobs per $1 million of GDP, and consumer growth creates 3 jobs. They're moving from a model that creates 12 jobs to 3 jobs with a real estate overhang. That's problematic. Now, they've got the pocketbook that can even out and buffer those risks for a while, but China's going to slow as they move to a more consumer-driven economy. And that means lower, and with 81 countries that claim China is their #1 export market, China slows, they slow. Demand for energy slows. The demand for metals slows. Why is copper falling? Well, copper is used as collateral when business owners get loans from banks, and when they default on those loans, they give the copper back and the banks sell it, and that's why copper is falling. Businesses are defaulting left and right, not often disclosed. China says they're growing at 7.3%. That's below their 7.5% target for the first time since 1990 and change. My work shows they're growing closer to 3 to 4%. If I look at electricity usage, down 25% since 2009. Home transactions down 45% in a year. Rail traffic down 9%. I mean, all the things that would suggest you're slowing are falling. Consumer confidence falling. Business confidence falling. Gambling receipts out of Macau falling. So that's going to be a gift because China's slowdown will create deflation in the U.S., but it's good deflation. There's good deflation and bad deflation. Good deflation is when energy prices and food prices fall. Bad deflation is when wages fall. And with wages and salary up 4.4% last year, that's not falling. That's growing faster than the rate of inflation. This economy is actually growing to text. You just needed to start your date, not in 09. And see, that's where a lot of people, again, misinformation. Average economic cycle, post-World War II, 20 quarters. We're in the 22nd quarter. So you'll hear people in the news show say, well, we're at the tail end of the economic cycle. No. Let's look a little deeper. Post-World War II, every economic cycle bottomed when real estate bottomed. So our economy, our recession was over first quarter 2009. Is that when real estate bottomed? No. Real estate bottomed the second quarter 2012. So the way this cycle works is first thing you do is you quit firing people. That's known as a leading indicator. So we watch unemployment claims. That was a 2013 event. Then you start hiring people. That was actually a 2014 event. And then what's the next? You start raising wages. That's a 2015 event. So we quit firing in 13, we hired in 14. You're going to start to see wages grow in 15 with lower energy prices, providing consumers who drive 72% of the economy more money. This economy, I think, is getting stronger, not weaker. Yeah, we'll suffer a little for the dollar. We'll suffer a little bit because of the drag on energy prices and earnings on the stock market, but the market's likely to do well. Actually, the best performing year of the stock market is the third year of the presidential election cycle. I always default to the same thing. If you were to come up with an objection on the market, we've never had a market, a year that ends in 5. We've never had a negative market in a year that ends in 5. So there you go. Except when the Patriots win the Super Bowl, the last 3 times the market was off 3.8%. So that kind of nullifies that statistic. But I want to just let you know that I think you're going to find that the economy is stronger than people think, regardless of what's going outside our borders. That central banks around the world are going to be lowering rates and injecting liquidity, and over time that they'll grow as well, so we'll benefit from that. And I would focus on the companies that derive the bulk of their business here in the U.S., so that it'll be their earnings and their stock performance that'll offset the multinationals that might have a negative from trying to do business overseas. I really appreciate your time. Second year in a row. We'll see if we can do it a third. You're probably getting tired of me, but I'll be more than happy to answer any questions on actually any topic. I'm pretty opinionated on a lot of things if you haven't figured that out. But yes, give some thought to some of my comments and let's see where we can go. Thank you, sir.
If you have a question for Richard, can you just please raise your hand and we will bring you a microphone. Just so raise your hand and Richard will answer your questions.
I know that you're optimistic about the economy, but from all the financial papers that I have read, there is lurking, like in the shadows, the fact that by 2018, they anticipate that about 2/3 of the population will be dependent on government for largesse of the public treasury. Does that not have a dampening effect on some of the optimism that you portrayed?
So if this study is correct that by 2018 there'll be a high percentage living off of welfare, if that's accurate, then by definition, you're right, the economy would slow. I will say that it will, I look at it a little different. I'm not always an optimist. In fact, my wife would say I'm a pessimist, and I would say, no, I'm a realist because I just call it how I see it. It will keep our economy from growing at its full potential because of this drag. Now, part of the problem is I can make $30,000 a year using the top 10 social programs that are available to me not to work. Then why work? Well, you and I have for self-esteem and because of just pride, but there are people out there that say, until I find the perfect job, I'm just going to keep getting a check in the mail. So maybe we need to change the incentives a little bit. There's not a person in here that has a problem with a single mother who's trying to take care of 2 kids from getting food and being able to live. No one has a problem with that. But I do speak with enough CEOs around the country who say, boy, one that I just think of right now who's in the technology business offered 2 programmers a job, and they says, well, it's not really exactly what I'm looking for, and so they just stayed on the government teat. They just, I'll just keep getting a check. That's a problem. And so maybe that changes over time. But my work shows that we're now seeing people coming back into the workforce because of the amount of jobs that are available. There's something called the JOLT survey, number of jobs. There's 4.5 million unfilled jobs right now. Part of it is a mismatch between the jobs and the skill set. So we have to have more people that are engineers and are just better educated. So maybe education is the real problem. Right now we have more sociology graduates than the medical, mathematical, physics combined. And nothing against being a sociology major, I guess, but I remember listening to this Canadian comedian in Toronto who said, people asked me how I became a comedian, and that's because the big 5 sociology firms weren't hiring. So I thought that was kind of fun. Exactly. So, I'll just leave it at that before I get into my social views. But I disagree with that. There are people that have been picking this economy apart for 5 years and finding, and I had this debate a couple of weeks ago, well, what about this? And it's the type of jobs, and the data no longer supports. It used to be the jobless recovery, and then it was the part-time workers, and then there was no wage growth, then it was no job growth. Last year, threw that out the window. We're seeing not only, and it's not just leisure, retail, or assisted living facilities, people pushing that are getting jobs. The diffusion index tells you that it's multi-industry people hiring, and we're seeing it. There's a real demand out there now. So I disagree with that. Yes, sir.
Yeah. What do you think about the proposed reduction in the repatriation of foreign profits coming back in? You think it's going to pass, and what effect on the economy would it have?
So we've got 3 political consultants that we pay, and I live in Annapolis. I'm 35 miles from the epicenter. I was just actually I did a big talk to a smaller group at Old Ebbitt Grill, for those of you that are familiar with that landmark, last week. I've been told that nothing major will pass for the next 2 years. Obama's been very consistent in his beliefs, and he's not going to change. So whatever he wants to do, if the Republicans are going to go no, and whatever the Republicans want to do, he'll just veto. That to me is actually a good thing for the market, because that just means I don't have to worry about political risk. It'll just be the same old thing. But as far as repatriation, why would I bring, so let me see if I have this right. You're going to allow me one time to bring money back here and not be taxed, but then you're going to tax it after that, at the highest level in the world. Why would I do that? Maybe a couple people, a couple industries, a couple businesses. But if you change the corporate tax rate forever, then I'm bringing it back. See, everybody thinks there's this manufacturing renaissance going on in the U.S., and boy, I would love to wave that flag. I'd love to say that, yeah, we're bringing it back. No, we're not. It's not true. I looked at the last 5 recoveries. We're average as far as bringing jobs back to this country compared to the last 5 recoveries. Why would you bring back jobs to the highest taxing country in the world? If you're moving out of China, you're going to Mexico. You'll go somewhere closer. But you're not bringing, yeah, there's some jobs, but for the most part, we're not bringing them back. Yes, ma'am.
No, I'm carrying the mic, thanks.
Okay. She got shy. There we go. That's okay. You can ask that question. Yes, sir.
Well, at Merrill Lynch, we thank you for coming today. Your research, along with Bank of America and Merrill Lynch, has enabled us to make our clients some very handsome returns, and particular statements about Europe. I know some of our investments have paid off thanks to you. My question is, and I know people think about this, and you might not want to answer it, but where do you see the stock market in the next 3, 4, 5 years? Do we see 25, 30,000? Do we see significant pullbacks? It's a secular bull market. It's great to be bullish on America. I've never met a rich pessimist, so if you could comment on that.
So where do I see the market? So I want to give you a reference, because I'm bullish now, and I was bullish last year. In fact, I've been maximum bullish for a while, but not always so. You're looking at a person that had a national conference call January of 2008 recommending that advisors move their clients to a 50% cash position. I thought the recession would be deeper and longer than anybody thought. And you had the head of the Federal Reserve say, oh, this is going to be a 1 or 2 quarter correction, a slowdown, recession, then we're going to go right back. My data showed that wasn't the case. So I was negative in 2008. I missed the bottom by 10%. The biggest call prior to that was April of 2000. I had another national call predicting that NASDAQ would fall 2,000 points. It fell 1,968. I was negative in 2000, 2001, 2002. So I'm not always bullish. I actually think they're going to lower the corporate tax rate in 2016, and that will extend the bull market. But normally, bull markets do not end because of age or valuations. Bull markets are killed by recessions. And the rule of thumb is Margins don't peak for 20 months until after wage growth. So wage growth is this year. Let's go out a year and a half. I get margin expansion, and markets peak 12 months after that. In other words, I'm not really worried about anything economically or the stock market until 2017. And if they do lower the corporate tax rate, I'll extend that longer. But right now, with energy prices down, the market should do well, not as well as last year. The reality of it is, if our economy has peaked, that means the ISM manufacturing has peaked, it's on its way back to 50, the average return on markets in years from peak to 50 is 7.5%. I'll take it with inflation at basically less than 1. So it's going to be a little more critical on what you own, because clearly the multinationals doing business overseas where there's very little to any growth are going to suffer. So investors are going to have to be a little more careful on what they buy, whereas before you can just buy anything. So I'm pretty certain that, again, money moves markets, but it's going to be money overseas that's going to buy U.S. stocks, and that's why large is going to beat small. And the growth value debate, I'm a little mixed, but I tend to favor value, particularly deep value, because energy stocks today are trading at a price to book, the cheapest they have since 1928. So that tells you there's probably not a lot of downside in energy, like the integrateds. I don't see how you go wrong there. And usually recoveries are they're the mirror image of the decline. So if you had a steep decline, you had a steep rebound. It just won't go back to the same price. Okay, yes, sir. Yeah.
Hi, I feel like we should carry you around the room on our shoulders after that report, so I appreciate that. But how you're optimistic about the economy in general, not necessarily the markets. How long do you foresee that going out into the future? When do you think we're going to be at our apex?
Economically or the stock market?
Economically, just the general economy and housing market and those type of indicators.
Yeah, the problem with that question, well, I think the apex will be July 28th. No, he was wrong. He was so far off, right? Here's the problem. And you and I have seen it since World War II. What happens? The Fed waits too long to start raising rates. So all of a sudden, inflation starts picking up. It goes too high, and then they have to accelerate that wage rate increase. What's going to be interesting is I think you're going to see the Fed raise rates for the first time in our lifetimes without inflation being in the red zone. And it's not that they're raising, they're just going to return to neutral. There's a way to calculate a neutral Fed funds rate. That's the rate where it doesn't stimulate the economy or restrict it. It's called the Taylor rate, and the rate is 2.32%. And where's the Fed funds rate today? 15 basis points. So they're actually being a little irresponsible right now. We're going to have full employment by the end of the first quarter. We'll be at 5.5% unless there's a mathematical reason why we're not. But we're getting close to that level. Growing 3% quarter over quarter, your Fed funds rate shouldn't be at 15 basis points. It should be starting to move towards that 232. The fact that they're not means, all right, now they're getting behind the curve. All of a sudden, wages really start to accelerate, and then we've got an inflation problem that we didn't think we would have. So then they just move too high. They block everybody out of the financial markets. Real estate seizes up again. It's not the driver that it used to be, but there's still a key driver. And then we go into a recession. And they do it every single time. And it looks like, we'll see. If they start to move in June, just a little bit, and I'll feel a lot more comfortable that they'll avoid this major recession. But right now, with the consumer likely to be in a stronger position for the next 4 or 5 years with low energy, because again, it's cheaper to get out of the ground. So we've got this excess supply. I wouldn't bet against the economy right now. I think that would be a big mistake. We need a body shot, a major storm that shuts down the ports and the ability to distribute manufacturing goods to create a recession right now. Yes, ma'am.
Hi, good morning. How do you see the global terrorism impacts peppered into the U.S. economy in the next 18 months?
So what keeps me up at night? Cyber terrorism, computers. And I really started to get worried about it when I read about the Stuxnet virus. Is anybody not familiar with the Stuxnet virus? Yeah. Oh, I don't know. Yeah, I mean, yeah, I should say. I'm going to assume that some of you don't. The U.S. and Israel created a virus that was designed to change the speed of a centrifuge that enriches uranium, and that's its only function. And we just put it on the net. We just floated it out there, and it searched everybody's computer, really a computer chip called a PCL, and all of a sudden, as soon as it found it, it just changed the speed, and Iran couldn't figure out, why is this batch of uranium bad? Because and they didn't, and then once it did that, it evaporated itself from the computer. So that was pretty scary, and that told me that we've got some people out there that really know how to get into our machines and do different. And we're seeing it already. We're seeing businesses, and healthcare got hit a couple years ago, and we probably all saw the special that showed somebody manipulating somebody driving a car, just eliminated their brakes and did their windshield. I mean, it controlled the car remotely through a computer by hacking into it. So yeah, that would be something that could really destroy or hurt our financial markets. And that's why we should print our bank statements to prove, no, I really did have that much money with you, because it can evaporate. The safest thing that you own is your smartphone, and the riskiest thing that you have is your personal check. I spoke to a group of CEOs, IT CEOs, and one gentleman is working with the country of India on avoiding credit card theft. And he said the same thing to me, and he said, so maybe you pay your lawn guy with your personal check, and maybe he's not a citizen. I'm like, you talking to me? Like, yeah, okay, so Juan gets a check. What does it have? It has my bank routing number, my name, my address, maybe a telephone number. You should have a separate bank account for certain checks with a certain amount of money, because it's just too easy. Ask my wife. She had a business meeting in South Beach 2 weeks ago. She doesn't travel maybe once a year on business, and her credit card got hacked, and we were buying all kinds of things in Philadelphia that day. So it's too easy. I can just pass by your wallet and with a scanner and scan your credit card information, go back to my hotel room and print credit cards and go spend. It's that easy. So your passwords need to be a little bit more sophisticated than the name of your dog with one capitalized letter. Think about a phrase, and it's a lot easier. And just, yeah, I worry about cyber terrorism a lot. Yes, sir.
Richard, I want to thank you for that presentation. It happens that I'm one of those crazy economists that kind of look at the numbers like you do. And a month ago, I made a similar forecast, but I started it with a Bob Marley song, Lively Up Yourself, because the numbers were very optimistic. Now, I wanted to ask you, because we are educators, how are your forecasts linked to the growth of people going to university? Because that's one of the biggest discussions right now. Do I need a bachelor's or a master's degree? And with the big student loan debt of over $1 trillion, it's starting to become a question for many households. Thank you.
Wow, that's a great question, because I didn't think I'd ever say this, but maybe not everybody is meant to go to a four-year or advanced degree. Maybe there's some technical jobs out there that will do just fine. I had a similar conversation with somebody in Atlanta. He runs a plant from Germany, and he said, you know, nobody thinks about getting a factory job when they graduate high school. He goes, we have great jobs and great incomes, and there's high-skilled jobs. It's not just somebody doing, you know, because of the technology involved, and nobody promotes that. There are only so many jobs out there for smart people, so I'm not sure that after 4 years I can't get a job. My daughter did the same thing. She goes, yeah, I'm thinking about grad school. I went, of course you are. It's fun going to school. It's tough getting a real job, right? I go, how are you going to get there? And she goes, well, aren't you going to pay? I went, no. No, I paid the first 5.5 years, right, of undergrad. She switched majors. You know how that works, right? Oh, yeah, I've got these courses, and it's going to be another 1.5 years. I'm like, that's just great. So, yeah, Daddy spoiled his only girl, but I did make one change. I said, when you're 25, you're gone. You can party all you want. You can just have a great time. But when you're 25, you're not living at home. No. And literally a month before she was 25, I didn't have to say anything. She moved out. It was great. So now I miss her so much. God, my only girl. Yeah, she's in Jacksonville working for a medical device company from Germany that set up their North American operations, so it's good. So I'll be moving to Florida one of these days soon, I'm sure. Anyway, you guys have been great. Oh, time. T for touchdown. Great. Hey, you guys have been great. I know you got to work today. Take care.